In this video, I'm going to briefly describe stock collars. What is a stock collar? Ironically enough, a stock collar is actually an option strategy that allows you to buy insurance, protecting your stock on the downside and renting out your stock to actually pay for the insurance, potentially creating you a win-win scenario, meaning you cannot lose on a trade mathematically for a particular point in time. Crazy, right? Let's talk about it. Imagine that you bought Tesla somewhere around $8.50 a share. And when you got into the stock, doesn't matter if it was here or here or here, but when you bought it nice and low. And then Tesla rallied a few hundred points. And when it got up to 1,000, you said to yourself, okay, here's exactly what I'm going to do. I'm going to create a situation where I cannot lose on this trade. So to go back in time and to give you an idea of why anyone would have done this, notice how quickly Tesla bounced from this 850 price range, boom, 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 and ran all the way up to this resistance. You could have, at that point in time, said to yourself, I want to sell a call option at this resistance up here that will act as me renting out my stock. That's right. You heard it here correctly. You can essentially rent out shares of a company if you own more than 100. And the premiums can be quite delicious. So imagine that you rent out your Tesla stock at $1,200. Now remember, you bought it down here at $850. So selling it at $1,200, which is essentially your worst case scenario, is a really, really good thing because you would make a killer profit. And if you did that, you would got paid money. I don't know if that's grammatically correct. You would have got paid. Oh well, we'll go with it anyway. $1,200 per share is where you would potentially be selling your shares and making absolute bank. You'd be getting paid to do this because you are selling a call option against the shares that you own. Let's imagine that you receive $10 per 100 shares. So you'd be getting $1,000 essentially in rent money in this example. Now, keeping in mind that you bought the stock at $850, you would now be able to buy a put option at $855, let's say, as an example. And that's going to cost you money because buying a put option is insurance, protecting you from the stock going down. A put option is literally the right to sell your stock at a particular price. Now, this $855 put option, let's say, would cost $9. So you receive $1,000 up here and you spend $9 per contract, which is $900 per 100 shares. So in this transaction, you would actually make $100, which is the difference between 1,000 and 900. And here's your two scenarios. You either sell Tesla at $1,200 a share, or you sell Tesla at $855 a share. But remember, you bought it at $850. So you're either going to make $5 per share, or you're going to make over $300 per share. And you're getting paid to do this trade. You're actually getting paid $1 per share, or $100 per contract. And this would protect you in case of something crazy happening on Tesla. So for example, now that Tesla traded up and then went all the way back down to 725, you would be able to exercise your put option and actually sell your shares at $855, realizing a small gain, but not realizing a loss. And now that Tesla is all the way down here at $760 a share, well, guess what you can do? Buy your shares and then, that's right, repeat the exact same process whenever you want. So now that Tesla is nice and low, you have the ability to wait for Tesla to go back up a little bit more up into this $900 level in a few weeks. Sell a call again at $1,200, buy a put again at a little bit higher than where you actually bought the stock, and you will create yourself a stock collar. I do have an absolutely revolutionary program on this, if I do say so myself, and that is under our online courses and clicking on Hedging with Options. Hedging with Options is a program where I'll teach you exactly how to sell calls, how to buy puts, what time frame, what expiration, how much you should get as a credit, what to do, when to buy them back, when to sell them. It's a very expansive course on protecting your capital. And this is a strategy, in my opinion, that if you have over 6 figures invested into the stock market and you're not doing this, to be as nice as possible, you are being a toucan. That's right. You're being a toucan. Don't be a toucan. Learn this strategy. It's very easy. It's very simple, and you can get paid to be patient. You can get paid to own your shares and to keep them and to protect them and to create cash flow from the stocks that you already have that aren't doing anything anyway. Ladies and gentlemen, that's Stock Callers. I hope it was helpful. Thanks so much for watching this video. And if you have any questions, post them in the comment section below because I will be thrilled, honored, and privileged to answer those questions for you. You rock.